Hannah Brejnholt Tranberg, you're a tax policy advisor with ActionAid Denmark. The European Parliament today, we're discussing lessons to be taken from EU third country agreements in the field of tax, particularly with relevance to developing countries. What lessons do you think the EU needs to learn, and what can we do?
So some of the things that the EU member states can do is when we're doing the double taxation treaties, which is basically what we were discussing, is start by doing a proper spillover analysis, basically looking at what are the consequences of the tax treaties. So what are the consequences on the developing countries? That's one of them. And then there's basically looking at what's the starting point on the tax treaties. So we tend to look at the OECD model is the one that we look towards, so basically making sure that the taxing rights stay in the richer countries, whereas the UN model would leave more taxing rights to developing countries, which is what we think would be a better starting point. It would be more of a level playing field with the two of them.
You mentioned this in the presentation, the difference between UN and OECD rules. Is there any barrier from developing countries using the UN rather than the OECD rules?
No, it's a choice. It's a choice that member states make whether they want to use the OECD rules or model or the UN model. And because the OECD is basically the rich countries club, if you like, so it's a lot of richer countries. The lower income countries are not part of it. So the rules there are set by the richer countries, generally with the richer countries' interests in mind. So obviously they will go for that first. The developing countries would tend to go for the UN model, but in a negotiation situation where the richer countries have more power, just because developing countries tend to want to attract FDI or foreign direct investment, which is fair, they would tend to then go with a lighter version and basically write away some of their taxing rights in order to attract the foreign direct investment.
Can you give me an idea of what sort of specific elements in these tax agreements would be unfavourable towards a developing country?
So some of the things that are less favourable, I would say, are around the definition of permanent establishment. So it's basically, how do you define where a company is really established? Is it really established in Denmark, which is my country, or is it really established in Ghana? So the outset there is different, and it's all to do with the length of how many months do you have to be in a country to say that you're actually established there. And then the length in the OECD model is longer than it would be in the UN model. So you're established permanently sooner with a UN treaty model, and that's one of the examples.
You've mentioned Denmark and another country. Is this something that is agreed on an EU level, or is it country by country, and in which case, which countries do a good job and which would you put on your blacklist?
So the negotiations happen at bilateral level, so they happen between two countries. As to which countries are doing a worse job or a better job of their tax treaties, and I would say which ones are more aggressive, it's kind of difficult to say, because sometimes you can have a very aggressive treaty which doesn't mean a lot because you don't have a lot of trade between the two countries, whereas another one can seem much less aggressive but actually has much bigger consequences because there's a lot of trade between the two. So it's not that easy. However, I would say there's a trend for across the board, I would say, for the EU countries to become tougher and tougher in the negotiations, basically bringing taxing rights more to the richer countries, the EU countries, and less to the source countries, the lower income countries.
One of the figures that was mentioned was an OECD figure that says that about 3 times the amount that is spent on aid is lost in tax revenue. What is the impact on that on these countries? And do you think that's an accurate figure?
So I think that it's very difficult to give an accurate figure because all of this is estimates. We don't have transparency on this. That means that a lot of this information is not publicly available. So it's impossible to have an actual figure. So it would be an estimate. One of the issues around when we're talking tax and development is that we often don't connect the two. So we don't take our commitments around policy coherence for development seriously enough. So when we're talking tax, we tend to talk tax, and then we'll talk development separately. But we have obligations to connect the two. So it's really important that we think about policy coherence for development when we're talking tax, and making sure that the impacts of the tax policies that we have are taken seriously in relation to our development policies.